peak, trough, lower peak off the area that we thought would be resistance, the 16,000, the 2050 cross has now happened as well. And we're right on support into the close. Jamie Dimon might expect 7 rate hikes, but the market is not currently showing that just yet. In today's video, we take a look at everything to do with the stock markets, crypto, and commodities markets right now. And here is an S&P 500 heat map for the close of the 18th of January 2022. And you will notice across the board, it almost looks like a crash is coming. Semiconductors were down a huge amount, leading the market further and lower than we've seen it in some time. And of course, we also had the banks coming out with reports, especially Goldman Sachs, and that was disappointing to say the least. Goldman fell almost as much as 7% through the session. So what does this mean? Do we see a crash happening? Do we see a correction happening? Many people are going to be coming out and calling the next great 30 to 40% drop. But I think a lot of this comes down to what is going on right now in the markets. And as we know, there are some big predictions coming through. One of those is JP Morgan's boss, Jamie Dimon. He said that he expects up to 7 rate hikes this year in 2022. Now, I find this very interesting to hear someone like a bank boss who may actually do well from interest rate hikes coming out with almost a 2 times number from what the Fed has said. And this is all to combat the idea of inflation. So do you think there'll be 7 rate hikes so far in 2022? Do you think that's even possible for the Fed to pull off? They historically have not done this. And I think it's interesting to also say, okay, well, if there was 7 rate hikes, what would we expect for the market? We'd expect the market to fall back down. Now you go over to JP Morgan's outlook for something like the 2022 period. What does Jamie Dimon and his head of research say? They actually expect the S&P 500 to continue robust earnings growth as labor markets recoveries continue. So they're actually expecting that the S&P 500 will go up and that in fact it will reach 5,050 by the end of 2022. A more modest increase than previous years, but of course an increase nonetheless. So I think this gives us a bit of clarity to, yes, we will see rate hikes. Yes, they're there to fix the inflation problem or to at least slow it down, which is a mixture of inflation, demand the Fed has seen, and also, of course, shipping costs. But will it cause the next great recession or crash? It is unlikely to do so just yet. And there are some big reasons behind that we'll be taking a look at in today's video. But another big bit of news is, of course, Microsoft acquiring Activision Blizzard. They are now almost a monopoly in this space. They've purchased plenty of game companies in the past, and now they've just done a blockbuster deal, Microsoft's biggest deal ever, I believe, almost $70 billion to buy Blizzard Activision and to, of course, take over one of the biggest well-known gaming companies out there with the Call of Duty franchise and all that Blizzard brings with it. What do you think about this Activision Blizzard deal? Is this something that excites you? Is this something that scares you a lot as a gamer out there? It's certainly something that is showing us that there's still an appetite in the markets currently for big acquisitions. And of course, companies are still making big moves into what is probably going to be a couple of really good years in the market if you know what you're doing. We've talked about this before. It's probably going to be a trader's market in 2022, similar to what we saw in 15-16 in the S&P 500, around that idea of the Fed rating or re-rating and starting the hikes and taking away quantitative easing, etc. But it's going to be one of those years that you've got to be nimble and fast. Let's take a look at what actually happened on the major indices through the close of the Tuesday session. And you'll notice here that everything started off down. It was all down 1.4 to 1.6%. And then it fell off further. And then by the end of the session, it was down almost even more. I mean, IWM here, 3% down. The Russell 2000 small caps showing that there is fear in the markets right now, hitting a critical support, very critical, by the way. Nasdaq 2.57 and S&P 500 1.84%. When we move over to something like here, when we see the sectors, not every sector was actually down for the session. Oil moved up and energy was up 0.4%, but semiconductors, solar, biotech, all down very hard for the session. And biotech was down 3.945%. So these were almost doubling the market in terms of how much they were declining. And it's a mixture of rate hike shock, and also probably an overemphasis on selling growth stocks at this stage in the market. That could turn out to be a major bad decision when we take a look at what will probably happen for the rest of the year. So let's talk about that right now. We've brought up this volatility chart many times in the year's videos so far. And if you haven't subscribed, definitely consider doing so as we bring data together with technical analysis, together with some fundamental concepts to really mesh and grid to this idea of trading, investing, and keeping things simpler, but also being able to cut through the current news. It's something that we do here as a community really well. So volatility is set to spike. We know that January and February are some of the worst months on record for many sectors. And in particular, of course, the technology sector is beaten down by this period of time. In fact, it doesn't tend to recover until that March-April period. So for anyone that's hoping for a quick rebound here that's all happy and V-shape and looks like 2021 and 2020, unfortunately, we're back into trading in 2022. We're back into this sideways market with growth over time, and therefore it's a trader's market. So we do expect some weakness here at the start of 2022, and then hopefully some strength coming into that March-April period. Now, we've talked about it before. Jamie Dimon might expect 7 rate hikes, but the market is not currently showing that just yet. It's showing a 1% on the 2-year. And as we've mentioned every single video this year, we've got to watch this 2-year yield. In only 3 weeks, we've gone from a 0.75 reading or a 0.7 reading all the way up to 1% in 2-year. And this is really showing that we're going to possibly at this stage, see 4 rate hikes. And this has now become the new expectation. It used to be 3 rate hikes. Before that, it was 2 rate hikes. And now it's becoming 4. The Fed tends not to be able to raise rates as fast as people believe. So this is to combat inflation. We've talked to many big experts out there, and a lot of people think that once they put in a few rate hikes, that things will start to cool. We've seen the Fed come out before and say things like, it's more of a demand-based scenario. They also are concerned about shipping. And if shipping starts to sort itself out, not showing any signs yet of doing that, that could also help to bring down this problem with inflation. But what do you think? Put your comments down below. Let us know what your thoughts are about the 7 rate hikes and whether you think that's going to happen. And of course, whether you think that a few rate hikes are going to slow all of this inflation concern, or whether you think there's going to be a lot more. So we'll go into what's going on right now. And it's time to be nimble and time to be fast, guys, in the markets. We're above 20 again on the VIX. And as we always say, and one of the things that we learned the hard way over the years is that swing trading doesn't tend to do very well when you have a high VIX. Because of the increased volatility, what markets tend to do is they go up, down, and all around. They have big swings both ways, big rip rallies, followed by huge dumps. That's the type of thing that happens when we go into a volatile, potentially bearish market. And a lot of people are starting to place bets on the VIX going back up to 32. I saw this in the live session today. A few people were mentioning this. It's very possible this happens. And if you trade the VIX, you would know that if we get through the S&P 500 weekly 20 exponential moving average, a key technical indicator, there's a chance, or a very decent chance, that the markets will continue to fall back down to what we call the 50 exponential moving average. If that occurs, what's going to happen with the VIX? It's going to spike quite a lot. So yes, the VIX could be in for a time here of increased volatility, increased spikiness, but it all depends on the weekly close and often depends on what the algorithms are doing. And it can be fast paced. So it's not for people that haven't experienced VIX trading before. Remember, it's very dangerous if you don't know what you're doing. Let's move over to the PCC. Put call ratios actually dropped on the session, if you can believe it. So this basically means that there were a lot of calls being opened through the session, showing that there's still a lot of bulls in the market, but maybe that bull is misplaced. And we'll look at some options trading a little bit later just to show how many people for this Friday's close are actually still going bullish with calls. There's a huge call walls in the market, which shows that the bulls have come out to play, but it's probably just retail thinking of buying the dip and going a little bit too hard at the wrong time to do so. We'll move over to gold, silver markets, and commodities before we get stuck into the stocks. Gold here, still trading around 1813. As we've mentioned plenty of times, we're looking for that 1830 plus close. And once that happens, gold is looking a lot stronger, but at this stage it hasn't done so. Surprisingly, silver actually showing improvement, like a lot of the base materials that are actually used in the economy, more so than gold is actually used. Silver is doing really well, 23.46 through the previous resistance. Could this be showing signs of further bullishness here for silver back up into the $24.80, even $25 here for silver? It's looking that way, a good first step in the right direction. A lot of other commodities were moving very, very hard. Oil, just notably here, 86.52. It's up so much now that it opens up the next level. It's gone to a new peak. So if you're worried about your next fuel fill up in your car, unfortunately, as this goes through supply chain, it looks like prices will rise. And especially for Australians out there, so I am Australian, it usually takes around 2 weeks for this kind of price rise to hit in terms of when you're going and filling up, and depends on your country how long it can take to get through there. But 92 becomes the next resistance. As we know, we've been following the 4-hour 20 moving average at so far with the oil trade, and that's been kind of where we've been picking it up. At this point, you would think the 4-hour 20 will come up, oil will probably rocket a little bit more, maybe pull back down to this zone, and the previous resistance around 85 might act as a good level of support. So day traders and scalpers and being nimble might be a good zone or an area that you could be looking at. Let's move over to Tesla. So Tesla didn't move as much as you would think through the session. It actually had a rally on it that moved upwards of around 4.24% before falling back to being slightly down on the session. And this is the problem sometimes with Tesla. It tends to do what it feels like and separate to the rest of the market. But as we know, $1,000 is the key, and it can be sometimes a day behind or a day in front. So sometimes rallies will happen, then the rest of the market will rally the next day, and then of course it will do nothing for that day, and so on and so forth. So $1,000 still one of the key levels of support. If a daily closes underneath this zone, then we move back down, you would think, to around that $900 price target. And I think day traders and scalpers are going to come in around 1,000. They're looking for some sign of support, whether that be a double bottom, whether that be a lightning bolt, whether that be a bullish hammer, an engulfing candle on a significant time frame. All these types of reasons, or your trading systems around 1,000 will be key, but I'm not sure the 1,000's going to hold. We'll find out whether it does. A few people are pointing out still inverse head and shoulders. That's fine, but remember, an inverse head and shoulders is not in play until it gets through the neckline, and that's quite far off here for Tesla at this stage. Move over to one of the other stocks we close and we always talk about all the time, and that's Apple. Now, Apple coming down to the 167 area. You know, or we all do, that this 50 exponential moving average, the blue line here, is the key level of support. And if Apple, one of the biggest stocks in the market, fails, then it's usually on for the rest. So we got the peak, we've got the trough, we've got the lower peak currently. Will we see a lower trough? Underneath 167, it's on for all of the market, you would think, at that stage in terms of short, and Apple could have a significant fall off. In fact, we're taking the range here, extrapolating that out and bringing back down to like a 150, 152 reading, and possibly even the previous trend lines. So this will be significant. Watch Apple, have it on your charts. 167, breach underneath that. It's a big deal across the board. The biggest tech stock, the biggest stock in the market, once it shows weakness along with the rest of the indices, it's on for usually all those stocks towards the short. Another thing we mentioned before was, of course, the massive acquisition here, Microsoft by Blizzard Activision. And they are now, you'd almost think, the biggest games developer in the world is Microsoft. A huge company has bought another huge company. Biggest acquisition ever. It's sent the stock up very hard. It's still quite a while away. It won't be finalized till 2023. But just to show you, the price action was already starting to look much better here on the stock. And there wasn't really too many loose lips because, as you would know, it should have already gone up a lot more if this had been leaked before. But it was improving, and we saw this across much of the game sector. What do you think about this acquisition? Are you scared for Activision Blizzard being owned by Microsoft, or is at least it better than what's currently going on with it? I'm going to go with it's better than what's currently going on. Arcade, another one we cover off here. you know, RK is not really showing us anything yet. We still like the sector when the price hits the right level. And what that's going to be is we don't know where the price is going to be the right level yet. We look for double bottom bases. We look for accumulation. And if you ever want a great concept of accumulation to go back and have a look at, check out BHP here on the Australian exchange. This is a massive fall. This is accumulation. This is an amazing area. That's the type of gain that you want. And remember, this is happening during a market downturn. So while the rest of the stocks and the rest of the market's been doing poorly, there is opportunity when you know where to look. And that's something that we really try to teach here on the channel, talk about it, educate you guys, and help everybody out there. IWM, big deal here. The small caps are weakening. We now have a new low off the previous rally. The small caps have weakened hard, and we are basically on critical. You can see only wicks have ever got down here. This is the first daily close underneath pretty much anywhere around this 210. And even then it was mostly just rallying off that point since the beginning. And this almost looks like a classic massive Wyckoff distribution at this stage. You've effectively got your constant resistances. You've got your max pain kind of false breakout. You get the market coming back down, and guess what's next? I mean, this is a Wyckoff accumulation, or distribution in this case, that should lead to potential falls here. And what's that pointing towards? Probably around this distance or channel style distance, and a fairly large sell-off. The bad news is we're at critical point here for bears. If Apple sells off, if the weekly 20 moving average we'll look at soon falls underneath, you can see the damage that can be done. And the reason this is showing up in the small caps is because if you raise interest rates, what happens? It becomes harder for small caps to get easy funding, to get cheap cash, and therefore profit as much. And weakness can often be found in the small caps that shows a broader market sell-off or broader problem through certain sectors. And there's a lot of tech in IWM as well, and financials. So as we see these reports come out and earnings come out, we'll find out whether this is all very weak. And if you're thinking of shorting here, I would probably say it's more likely that you get a rip. So you might see another sell-off, a rip back up to this, acting as now resistance, which was support. And generally shorters will get another opportunity to get in the company or get in the stock towards the short. It is tough. So remember, shorting is not for everybody. Selling the market is much tougher than buying the market. And sometimes just waiting and looking for the best buy zone is one of the best policies. A lot of people struggle with shorting, and that's why options can be one of the best places to short, but it can be expensive if you don't know what you're doing. And I think it's a big thing for a lot of beginners out there. Don't try to short the markets. It isn't easy. Let's move over to the Nasdaq. The Nasdaq is weakening. You'll notice this is the first daily close below our trend line. This is our community trend line in quite some time. So again, peak, trough, lower peak off the area that we thought would be resistance, the 16,000, the 2050 cross has now happened as well. And we're right on support into the close. Are we through the trend line? The answer is yes. Have we seen a new low? The answer is currently no. So we don't seem to have that full-on signal, oh, we're ready to short. But you would think now that any rip, so any big bull movement, let's say a bull movement back up here to the 15,540 or 50 area, previous support is now going to act as resistance. So even if the market has a recovery, there's a good chance the bears are going to be here trying to push this back down. This is a big change in sentiment over the last week, and especially over the last 24 hours. Let's go over to the SPY or the SPX. The SPY closing slightly underneath the wick purchase, again underneath our trend line we've been using for a long time. Big deal here, underneath the 460, another big deal. We know there's been a lot of put support here around the 460. That is no longer there. And I think a lot of this comes down to a big trap that Wall Street's been playing with the options. So when we have a look at the options, and we mentioned this on the weekend video, for some unknown reason, there was a lot of people opening options up here. I don't know who was doing this, and I hope it wasn't you guys, but there was a 500 strike, huge amount of option calls opened at around this level. And then we've seen a lot of extra. In fact, this has increased over the last day of trade. As we mentioned with the PCC, more people are going bullish calls. I'm not sure it's time to be going bullish calls from my own personal opinion here when you're thinking about the price action. Look, it's good to be optimistic on markets, but this is improving greatly here on bull calls, and it's surprising because this is what we call call walls. Effectively, it makes it very difficult for the market to close above this come the expiration on the 21st of January. And remember, we don't have any news coming out from the Fed yet. So the Fed will be coming out next week having a discussion about what's going on and give the market further clarity. And clarity is the key. When the market doesn't know what's going on and doesn't know what to expect, it has, let's say, lucid dreams. It goes crazy, it doesn't know exactly what's going on, and it becomes fearful. The market likes certainty. So we do have some interesting strikes here. We've got kind of like a 450-ish amount of puts coming through here. So we do have a large amount of puts around the 450. We've got huge calls though open at these two strikes, which just boggles my mind who was opening these. But anyway, they're there. And it means that the market is unlikely to have big rips to the upside because there is some levels here that are going to be hard for it to get through. I also just want to bring up the SPX just to show the slight difference between the ETF and the real market. That is the SPY versus the SPX. It shows a clearer break to the downside here. So again, any rip you would think would be met by seller demand at certain levels. 46.50 going to be a very hard level for any big buyout to be going through. And I think bearish sentiment is starting to come into the market. We could already see a little bit of topping and a weakening of the trend, but we have a long leg doji here on the weekly. A high, a low, an open, and a close. If the market closes a weekly underneath this 20 moving average, we've talked about this for a year. If it occurs, it's a bad sign. It's generally what sends the market to the next point of, I guess, reversion. And the mean reversion has happened, so therefore it goes down to the next level. You would think that is the 50 exponential moving average. So there could be another quite a few percent here going down to the 4,300. Do you guys think that's where the market's going? That will bring us to a 10% decline top to bottom, and actually a good correction, a healthy correction. We're not talking crash here, though a lot of people will be talking crash, because when interest rates hike, we don't know yet whether that's going to have a material impact and everything to do with inflation. If one hike starts to scare people, which often it does, especially when the market does these types of things, it creates this big effect of lack of people feeling confident. And when confidence is key in markets, it can really be a big deal. So I'm not going with the 7 rate hikes. I feel like it'll be 2 to 3 in 2022. But I'm always open for change. We have to be adaptive as traders and investors. And at this stage, we're looking for that weekly closure below to give us that strong signal towards the weakness. Let's move over to the crypto market here. What's going on? Ethereum recovering here like Bitcoin. Went underneath 3250, pretty much sold off due to something like the tech stocks and of course stocks in general falling through their lows. And it does show you that the crypto market is kind of susceptible to those types of movements. A nice pickup here in Ethereum. If it moves above the last session high, especially if it closes here in 1 hour at around this price, you could think it's a bullish hammer or pin bar. A follow through momentum should push us up to 3,400. And of course, a closure above 3,400 will put smiles on many people's dials if they're in the crypto market, because that will be a big deal towards the bull side. Same thing's going here for Bitcoin. Bullish hammer, bit of a rip coming back through, a closure, and then movement above the high should show some follow through momentum. 44,000 becomes the key resistance. We know that. And any move above 44, you think is going to 46. Previous support, big deal here. Big, huge levels. A lot of people have been bringing me up BTC shorts as well and saying, look at these shorts. They're improving. They're increasing. It shows the whales are getting ready to dump. And yes, it is increasing. So we really do have here a movement of BTC shorts going up. The big whales are starting to place short positions, but it's nowhere near the last big crash levels. So while this matters, we need to see it spike a lot more for us to really get concerned. And of course, if it's spiking at the same time as we see the market go underneath like a 41,000 or a 40,000, more particularly for Bitcoin, we have to pay attention. The whales are on, and you would think that's going to be have a real adverse reaction to the rest of the coin market. When we move over to the news for the week ahead, as we saw, there wasn't as much news as a lot of people would have thought. And we go through the Wednesday here, the markets are being left to their own abilities to really kind of make their own decisions and potentially have some freakouts leading into the actual reality. Let's see what the FOMC statement's going to be. Wednesday, January 26th, we'll find out, 2 p.m. New York time, federal funds rate, the press conference half an hour after that. This is going to be the big bit of news that should give the market a little bit more clarity to what's going on. As always, if you enjoyed today's session, please remember to subscribe. Smash that like button, guys, does help us out, and we'll see you in the next one. Good luck out there, nimble and fast. That would be the story of today. Bye for now.